part of what we're doing here in this group is we're doing a very conservative approach to investing that I've used since I started investing in 2008 during the great financial crisis. That's when basically I started investing. Until then, I was buying CDs, very conservative. And so I've learned what's known as value investing. Value investing is basically trying to find quality companies that are durable and can grow at a certain amount that sometimes pay dividends. And I'm also good at buying growth stocks. So you try to buy a stock that's undervalued and you try to hold it long term until the thesis that you originally had doesn't work anymore and the stock doesn't work anymore. But for the most part, I'm trying to buy buy stocks that are for the long term. And so I avoid topics such as day trading and trying to make money certain ways, because we can't actually do that, where we work. We have a limit to what we can trade, just because we're working where we're working at. So so part of what we do is we look at charts and we look at patterns in the stock charts, and we look at moving averages. What we're going to do right now is we're going to look at the S&P. The reason why the S&P is so important is almost every stock has a certain correlation to the S&P 500. And right now that the S&P is actually it's going down today. We have a market that's pretty much fixated on inflation and interest rates right now. So we have reports coming out every day about interest rates and inflation, and that totally has a one-to-one correlation to what people are willing to pay for stocks. The interesting thing about today in the stock market is we have, let's look at some of our stochastics for today. Okay. You can see in the S&P, we've had like this up channel, in black for at least since last November. We broke out of that last week, and we're starting to make this new pattern that could be, it's something new. I don't know what it is. It's not normal. It's out of our range. So we've broken our trend there. We're oversold now in the S&P. And the interesting thing we looked at in our dynamic chart from right now is we're at the 50-day moving average. And a lot of times whenever you look at stocks and look at charts, the moving average gives you an idea of the momentum in that stock or that index. So right now, we're basically losing momentum in a lot of the market. We're running up. And what happened in this past couple weeks is we're finding that our economy is doing really good, and we're not going to be cutting interest rates. And so it looks like we're right at the 50-day moving average, and we've held that since last November. If we see a break through that, then there's a good chance we'll go down to this 100-day moving average. And if we break through that, we'll go to the 200-day moving average. And the way stocks and indexes work in charts is there are algorithms out there where if you had a prior level of support, that usually holds for a certain time. And the way the stocks go down in a down market is you have these circuit breakers almost, the times whenever a stock held up in the past. And usually stocks have support at those levels as you go down. But right now the most powerful thing for stocks or indexes are the moving averages. And that kind of gives you a little bit of support. And sometimes there are algorithms that say whenever it gets down to a 100-day moving average, then start buying. But it looks like since last week, we've gotten to an oversold level, and we have a combination of two things. We have an oversold, and we're at a moving average. So those are usually good indications that we're approaching a time to buy. But if we look at our calendar, we also like to look at the big picture of what happens in the stock market. There are major events that happen. Right now, what's happening is we're starting earnings season. So there are 4 quarters through every year. Every quarter has an earnings season. So right now we're starting the earnings season today on the 12th with the banks. And what's going to happen in the next week, we're going to have some lesser known earnings reports. And then we're going to have the tech earnings reports. We're going to have Microsoft, Apple, Google, all of the big tech stocks report. A lot of times that carries the market or makes the market go down. And I have green on the calendar for that time because we're getting to a point where we're oversold right now. And we know that April has traditionally been one of the best months of the year. So if you put all those together, we're getting to a point where we're oversold. We have earnings coming up. And that's a good combination of, we have a Fed meeting date also coming. So, all right. So so we're expecting probably in a week or so for all this selling that's happening now to stop, and then we'll be focusing on earnings instead of interest rates. Okay, so I had some major points to bring up that happened in this week. It's becoming evident that we're having a stronger dollar, and what that is, the dollar is always compared to other currencies, and if our dollar is weaker, that means the companies such as Microsoft, Google, that do business overseas, they'll do better on their earnings report because the dollar is weaker. But right now what's happening is the dollar is getting stronger, and that's going to be bad for some of the multinationals. There's reasons for a stronger dollar. There are some banks around the world cutting rates. So if the ECB, the European Bank, and the England Bank, they're all on a path to cutting rates, and that makes the U.S. dollar stronger. And when the dollar is stronger, that makes commodity prices higher too. So all this kind of works into what people are willing to pay for stocks. So someday I'll put up a formula that says, if you have this price of oil and this interest rate, then you're willing to pay this much for a price to earnings of the S&P. I don't have that formula yet, but we're keeping track of this. The price of oil is going up. There's a lot of geopolitical tensions. There's Iran and Israel, possible war. We have Ukraine attacking oil facilities from Russia. And there's cuts in oil production. So all this is leading to higher prices in oil. And that hurts, and that makes inflation worse. Things that are happening this week. We have tax day coming up next Monday, I think. And people have to sell stocks to pay for taxes. That's a short-term thing. That's why we're still thinking we're going to have some selling until maybe next Wednesday. And Monday we're going to have retail sales. There's government reports of retail sales. What that says is if we have a strong economy and people are buying a lot, that's bad for stocks. That means the rates are going to go up. And if we have a weak report, that's good for stocks. So whenever we're investing, you have to keep track of these variables. These are some of the most important variables that affect what people are willing to pay for stocks. And you got to keep track of those things. And another important factor is the consumer. Consumer is, I think, 70% of the economy. And right now what's happening is they're falling behind in payments, their credit payments, their credit scores are going down, and they're being tapped out. So the economy could slow down if the consumer doesn't spend a lot. And we're getting all kind of little hints, like canary in a coal mine hints, that the consumer is tapped out. Like, for instance, the dollar stores, they're closing their stores because the lower end customers are cutting back in their purchases. And there are a couple other, these are other reasons, behind in their payments. They're foreclosing more. So that's some ideas to keep in mind that happened this week. All right. So if we go back to our calendar, we expect, the tech earnings to be decent. They're going to be affected by the strong dollar, but we still expect them to be good. And that could make the stock market go up. What are the things we have to look forward to? We have a holiday in May, and that usually around holidays, stock market goes up. What else? That's it. Okay, so let's look at some of our momentum information, or some of our major variables in the stock market. The S&P has been going down. We have a loss of momentum. The number of S&P stocks above the 50-day moving average is going down, and the number of stocks above the 200-day moving average is kind of the same. So we're actually, it's going down. So we're losing momentum in the stock market. So if we look at our chart here, you can see we're actually breaking a lot of these uptrends that we've had, and this is also evident in a lot of the stocks we're following. So if we look at our stochastics, you can see that we've had these channels for a long time, and now we're breaking out into this something else. And that's a sign of a breaking of momentum and down next. You can see that QQQ, we're in that same kind of, we might be going sideways to down. Defense is starting to break out of their uptrend. And almost every stock is following this. But gold is actually going up with all the commodities. So that is, we'll go over gold a little bit later. Gold, that could be, people buy gold as a constant source of a steady form of, it's a constant value in whenever currencies are wild like they are now. So if you buy gold now, that it'll still have the same value maybe in 20 years. And right now there's a lot of geopolitical attention, and then there's the dollar is trading up and down. We have the treasuries going. There's a lot of uncertainty, and people are gravitating toward gold now. The other two things about gold is China, Russia, a lot of countries are actually buying gold because their currencies aren't very stable. So through all this, we have gold appreciating, and whenever there's inflation, this is a good hedge against inflation. And right now, there are stories every day that inflation is stubbornly high. So whenever gold's back to normal and it's not in this uptrend, I'm thinking about putting 5% of my money at least in gold, just so I can have something constant in my portfolio in case there's currency problems. Let's look at, so you can see a lot of these sectors are starting to go sideways instead of in an uptrend. So XLB materials are in an uptrend because that's commodities. All the commodities are doing good. I think that's a correlation to the dollar going up. Let's look at XLC. This is one of the only sectors that we're following right now that's still in an uptrend and overbought. You can see the healthcare, which was going up most of this year, is starting to go into a sideways pattern. And this was one of the best sectors up until like last week. And all of the health-related sectors like pharmaceuticals, they're all following the same pattern. So what we're doing in investing is we try to buy stocks whenever no one else wants them and whenever the sector is out of favor, but the fundamentals are still growing at a certain amount per year. And right now we've had a lot of excitement in the stock market. People are excited and they bid up the price of stocks. Right now we're getting a little bit of sideways action to selling, and that's going to introduce some fear into the market. So you can see almost every sector is breaking out of a long-term uptrend into something sideways to possibly down. We don't know that yet. Okay. But you can see energy, this follows the commodities. It's going up and it's in an uptrend. So this is probably going to be one of the better sectors this year. So if we look at our best to worst, okay, this is our best to worst chart. Last year, energy was one of the worst performers. And January 1st of this year, we said, well, a lot of times the worst of last year turned into be the best of this year. And that's actually coming true. The energy is actually probably the best sector this year to date. And that's in part due to all these geopolitical issues that are coming up and to cuts by OPEC and a lot of other reasons, and inflation. So right now, energy is probably going to be one of the better sectors, and it has one of the best charts. And financials are doing good too, and they're reporting today. So J.P. Morgan and Wells Fargo, they're coming out with their earnings reports today. One of the most interesting things that Jamie Dimon from J.P. Morgan said, he said interest rates are probably going to be going up, and that's bad for the stock market. And he said that interest rates could go up to 8%. And he's pretty smart. And he says inflation is stubbornly high, and it's probably going to remain high. And that's kind of freaked everyone out. And because that could cause a lot of problems. If there's higher interest rates, that's bad for stocks. People are not willing to pay as much for stocks. So let's look at our other notes here. Okay, so we're seeing an uptrend in the 10-year Treasury. If you can see this higher highs and higher lows. And that's starting to have an inverse correlation again with price people are willing to pay for the S&P. So you can see the S&P is going down while the Treasury rates are going up. So you see, the price of oil hasn't changed since last week, and we're keeping track of all these. The dollar index is up 1%, and the price of gold is up 4%. So commodities, materials are starting to outperform, and I think could be we're getting into some kind of high inflation, and possibly the dollar going up more. The fear greed index, people are starting to get more fearful. Last week it was greed, and you can see as the stock market, this is like a pretty silly for us to go over this because it's a 1-to-1 correlation to the S&P 500. As the S&P goes down, people get more fearful, and as it goes up, people get more greedy. So we're not at the point where it's time to buy yet, because it's whenever there's extreme fear in the stock market, people are just selling. We have to then start buying and or picking our places that have the best bargains. So we are starting to navigate. I'm thinking if we have no interest rate cuts, or we have some kind of treasuries going up a lot. That could make the stock market and the participants extremely fearful. Let's look at the sentiment survey from AAII. People are still bullish, basically, but they're getting less bullish every week. So pretty soon they're going to be bearish, and that's the time to buy. But they're more bullish than bearish now. All right. So I mapped out the U.S. dollar. You can see we're in an uptrend here. This kind of is almost the same as interest rates. So this is bad for the stock market if the dollar continues to go up. Because if the dollar continues to go up, the price of oil goes up with the dollar, and the multinationals that do business overseas, they're not going to make as much when they import that money back into the United States. So we have a bunch of problems that happen when the dollar is strong. I guess the good thing about having a strong dollar is if you go to Australia for a vacation, everything is 1/4 off. Everything is 1/4 what it normally would cost. But, or if a United States company wanted to buy a company in another country, it would be less expensive. All right, so let's look at the VIX. The VIX it's about the same as last week, so people aren't panicking yet. It's whenever the stock market goes down a lot, the VIX will go higher, but we're not there yet. We're still at a point where people are fearful, but they're not really selling and exiting stage left for everything they own. If we keep track of all the issues that could lead to a crash, interest rates remain higher for longer is the theme of why the stock market is going down today. In inflation, high gas prices causes inflation. That is another issue. Persistent inflation. Consumer debt is another thing I mentioned today. The delinquencies are happening. All this kind of combines to a slowing of the U.S. economy, and that makes the stock market go down. Let me see. I think that's all we have. We had some disruption in the supply of oil. We have a possible war that I talked about in Iran against Israel. So we have all these kind of are adding to the stock market going down. So if you look at all these are all something we're worried about. And if any of them happen for an extended period of time, the stock market probably will go down. All right, so we're keeping track of this. This is the PE, what people are willing to pay for stocks at different rates. And right now, the rates are going up. So people are going to be willing to pay less and less for the S&P. So that could make a correction in the S&P. All right, so we went over that already. Okay. Dan Now's best picks are still doing really good. 24% on Amazon, 47% for Meta. These other ones didn't pan out at all. They're basically break even. So Texas Instrument, the biotech ETF, and the Chinese web ETF haven't gone anywhere this year. Let's look at what's going on in the stock market right now. Okay, so let's reload. Okay, for the S&P, we're basically right at the 100-day moving average. If we break through that, there's a good chance we're going to go down to this. No, we're at the 50-day. It'll go down to the 100-day moving average. Let's look at what's going up and down. Okay, we have a lot of momentum stocks. The sectors with the biggest momentum that have been doing good this year are starting to go down. The ones that are doing the best, gold stocks. So people are gravitating to gold. A lot of times whenever the stock market crashes or goes down, people buy gold. It's like more of a safe trade. Oil is going up. I mean, it's one of the best performers today because the price of oil went up 2% on all this tensions in the world. And okay, let's look at some of what's going on in the stock market. I'm expecting, okay, a lot of insurance companies in the top 10. So the price of insurance, if you haven't noticed with your auto insurance, is going up a lot. And that's for every type of insurance. So I guess in this environment, that's one of the safest sectors. Let me see. Newmont is a gold miner company. So we have gold, we have oil going up, and Northrop Grumman, they're a defense contractor, and Walmart. These are all very conservative sectors. Okay, and the ones going down the most, look at this. The ones going down the most, okay, we have JP Morgan. They had earnings today, and they warned about problems with inflation if it continues. They said that interest rates will probably be going up, and they might have problems with inflation. And we also know that people are not paying their credit card bills on time, so they could have a lot of charge-offs. So whenever banks have a lot of charge-offs, they have to reserve money for those charge-offs. And that means they can't invest that money. So they make a less return if they have more charge-offs to pay. So you're going to have all the banks possibly going through that same problem now with the consumer strapped. Let's look at a lot of semiconductor stocks. Intel, ON Semiconductor, AMD. So all these AI plays that were doing good until now are now doing bad. I don't have any insight on the other ones here. Let's look at one more. Okay, one's doing the best. Apple is holding up. It's not going down. All these are semiconductor stocks. Global Foundries, most of them are semiconductors. Okay, so semiconductors are up like 30% this year. So there are people that are taking money off the table now. These are all conservative stocks. The CSX, their railroad. You have T-Mobile, phone business. Apple has gone down a lot, like 10% or 9% this year so far. And so it's one of the stocks that hasn't appreciated. So it's like a worst to first. This is the worst big tech stock performance this year. Now it's becoming a little more stable. All right. So what we're going to do, we're going to talk about, I hate to spend too much time on this, but gold, oil, and a dollar is super important variables for the stock market. And this Muhammad Al-Arian, he is a former, I think he used to run PIMCO, and he knows a lot about treasuries. He knows a lot about fixed income investing and commodities. So whenever he says something, I pay a lot of attention. He was saying about why the price of oil is going up, why the dollar is going up in gold. So I already mentioned why these things in my other talk. But he said gold is a better hedge against geopolitical tension risks than government bonds due to U.S. inflation concerns. So as inflation goes up, gold actually goes up. And central banks are buying gold, and there's a lot of upward pressure on gold because of the supply and demand issue too. And with hot inflation prints this week, the Fed may not cut interest rates. That was on our list of possible things to cause the stock market to go down. And so there's a lot of people saying that there might not be cuts. If that happens, we might have a sell-off in the stock market. So the probability of a rate cut in June dropped from 50% to 15%. So it looks like there's not going to be as many rate cuts as they thought. and that's not good for the stock market. So all in all this, what this means is people are not going to pay as much for the stock market, and the stock market probably is going to go sideways to down this year. So we'll see. I put some interesting charts together here. This is the price of gold. This is the chart of gold. You can see it's in an uptrend, and it's super overbought, and people are piling into it right now. Now, if we have a sell-off in the stock market, this will continue going up because people gravitate towards something that at least has a consistent value over time. XLV, I already mentioned a lot of these already. We've had uptrends so far this year, and last week we basically broke out of that uptrend, and we could go sideways or we could start going down in a lot of these. So interesting thing about Apple, it was one of the worst performers this year, but it got an upgrade this week, I think. I'm not sure, but yesterday it went up like 5%, and but it's still in this channel. It's going sideways, but it held at this level here when it was oversold. So I guess in a world of if the stock market sold off 25%, if that happened, some of the big tech stocks, they'll hold up probably the best because they're still making money. They're still growing, whether Apple's only growing at 3 to 5%, but still it's a level of consistency when other companies have to borrow money at higher rates to survive. So I'm going to keep our eye on that. And this it seems like this sideways pattern for Apple is kind of holding. Google. This is example of a chart where we're overbought and we're at the top of the channel. So there's only one way to go for Google. It's probably going to go back down to here. And part of what we do here is we look for times to buy a stock whenever it's oversold within a channel, in an up channel, and we note whenever it's high, it's like at the top of the channel, it's not time to buy now, or it's time to sell. But Google's been a pretty reliable stock so far this year. JP Morgan, you can see that today, at the beginning of today, it was at the bottom of its channel. It actually went down 5%. So it's basically down at its 50-day moving average right now. So it actually broke that uptrend. A lot of times when a major stock in a sector breaks an uptrend, we're seeing a lot of breaks of uptrends right now. I'm just mentioning that because that indicates a lack of momentum in an industry, and we're just following that. NVIDIA, you can see that they're actually still in an uptrend, and they're oversold at the bottom of their channel. So it's been relatively. It probably went down today, but let's see if it holds this channel. This time next week. Okay. Part of investing, you have to. Part of our worst to first this year, we knew that sectors did bad last year, could do better this year. You can see that telecoms, energy, financials are doing good this year, and there are sectors. Real estate is probably one of the worst sectors this year, but you can see the sectors that did good last year aren't necessarily doing as good this year. That's why you try to have a diversification in what you buy, and whenever you buy a stock, you want to make sure you understand what sector it's in, so you're not too overloaded in one sector. Okay, so that was good. I thought it'd be interesting to go through. We do this every now and then. Are you diversified? And Jim Cramer does this probably once every month or so, and he picks some stocks. Corey calls in from Georgia, and he wants to know, is his stock portfolio diversified? And Corey knows that he's chosen all of Jim Cramer's picks, that he talks about. But still, you have to look, are you in the same sector? Are you truly diversified? If not, they recommend a different sector and a different stock to put in. Okay, so is there anyone here that could look at this and say any changes that could be made to make this more diversified, or is it okay? Okay, we have AMD, we have NVIDIA, we have Microsoft, Costco, Builders First Source. Builders First Source, they do building supply for housing industry. Costco, of course, is a retailer. We have Microsoft, a tech company, AMD, and NVIDIA. They're also tech companies. Any ideas?
I think is too heavy on the tech, and not a diversified, not very diversified. I think Costco is good. Yeah.
The Builder's First Source isn't like a normal, it's not a really big stock. Yeah. But this is one that Jim Cramer in the past has highlighted on his show. So the guy that's calling in knows it's a good stock. But okay, so that's great. What would you replace? Which one would you take out, and what would you replace it with?
So you mean you can only have up to 5 stocks, or you have more?
Well, in this, we're trying to give advice to Corey. You know, we were to say, well, you're too tech heavy. Which one would you recommend taking out, and what would you put in its place?
I would take out AMD for now, and put maybe the Berkshire Hathaway, the one. Yeah,
that's awesome. Yeah, so Berkshire Hathaway is a financial and insurer. So we know that insurers are kicking butt today. They're like the best performer. You know, Berkshire Hathaway owns Geico, and Geico is charging such high rates in their insurance right now. So they're really doing good. So that's 2 good things on their side. The financials were underperforming last year, and they're starting to outperform this year. And on top of that, the insurers are charging more for the product, and they're getting away with it. So that's an awesome suggestion. Let's see what they said. Okay, so they did get rid of AMD. Jim Cramer recommended getting rid of AMD and Microsoft because he didn't want too much tech heavy, and he replaced it with GE Aerospace. GE split their company into multiple companies, and they left the basic company with the aerospace. So he said replace it with GE and replace Microsoft with Eli Lilly, for healthcare. So you can see in our global stock market, we have consumer discretionary, which is kind of retail. We have healthcare, we have industrials, and information technology. Okay, so that gives you more diversified portfolio. So that was really, you were on the ball. Yeah, that was great. So I think that was a very good suggestion. I think you won the award that time. All right, so we have another one here. Of course, this guy chose all the ones that Jim Cramer recommended. Eli Lilly, Chevron. Eli Lilly is the healthcare stock. Chevron, the oil company. Berkshire Hathaway, and they of course, we just talked about them. Visa, which is a credit card processing company, financial, and Walmart. Does anyone have an idea of if this portfolio is diversified? If not, what would you recommend? What changes would you recommend? All right, we're going to see what Jim Cramer says anyways. Okay, so basically Jim Cramer said this is a well-diversified portfolio. We have Eli Lilly Healthcare, and healthcare is Eli Lilly. We have energy with Chevron. We have Berkshire Hathaway Insurance, a financial credit card company, and Visa, and Walmart is a retailer. So we have a truly diversified portfolio here. we don't have any tech. I guess Jim Cramer could throw in, a tech company he likes. He likes NVIDIA better than anyone. But I guess you could say that he has two financials. You have Berkshire Hathaway and you have Visa, but they're totally different industries. So I guess this is very diversified. Right. So let's look at the next one. We have Supermicro. They do servers, and they're very, very close to NVIDIA. They work with NVIDIA, but they make servers. CleanSpark, their energy company. Rivian. Rivian is a auto EV company. McDonald's, their retail fast food company, and Uber, and they're like a transportation company. Any idea for this portfolio? What changes would you make, or do you think it's diversified?
Maybe McDonald's is sort of a retail, I guess. It's fast food. I was thinking, a big retailer or a manufacturer or a bank.
Yeah, you said retailer and manufacturer.
Yeah,
manufacturer.
Like Walmart.
Okay.
Walmart, Costco. And maybe something a little more towards the financial services.
Oh, you said financial services?
Yeah.
Okay. Let's see what Jim Cramer says. Which one would you take out?
Uber. I think I take out Uber.
You would take out Uber. Okay. Let's see what Jim Cramer said. He said, these are sectors right here. He said no changes, but he said there's too much speculation. So Rivian is actually losing money. They're actually competing against Tesla, which is cutting their prices, and they're having a really hard time with being profitable. So Jim Cramer said no changes, but if we were to look at this and say we have a tech company with Supermicro, we have energy company with CleanSpark, we have auto company with Rivian, I would take out Rivian because they're not profitable. I would replace it, with Walmart or Costco. We have two techs, actually. We have is Uber a tech company? No, they're like a transportation company. They're like company like UPS. They're actually delivering things, and they're a taxi company. So it's not different than Supermicro. So I guess that's diversified. And McDonald's, that's decent. Okay, so I guess we can add retail, we can add Walmart or Costco, and then financial. What financial would you add in here, Matthew?
JP Morgan.
JP Morgan, that's an awesome one because they're very consistent. They're the best bank in probably the country, probably the world. They're the biggest bank in the United States. And they have whenever you're a larger company like JP Morgan, you have a scale, you have an advantage of scale that you don't have with smaller banks. And they're actually playing the long game at JP Morgan. They want to be a dominant player 10, 20 years from now, so they're not taking as many risks as other banks need to. Okay, so he said, Jim Cramer said there's too much speculation. He didn't say what stocks were speculative. One more, this is the last one, I promise. Okay, we have Verizon. They're a telecom company, and we all know them. And Abbott Laboratories, they do primarily diagnostic, and they have some pharmaceutical. So they're a healthcare company. Palo Alto, they're a cybersecurity tech company. We have Pfizer, healthcare company. They sell pharmaceuticals. And Kraft Heinz, and they're a food manufacturer. Any idea about if this is diversified? If not, what changes would you make?
Yeah, I think no changes.
No changes. Okay. Right. Let's see what Jim Cramer says. Jim Cramer says, keep Verizon, keep Abbott Labs. He's big on Abbott Labs. He likes it. He said, remove Pfizer because there was a duplicate. Abbott Laboratories, their healthcare, and Pfizer is healthcare. But Pfizer isn't growing that much. They are. Let's look at the chart of Pfizer. EFE. Just for fun. Okay. You can see this is like the chart of death. I mean, going back to 2 years, they are in a downtrend. And you can see that is like one of the worst charts that you'll ever want to look at. And that's primarily because they're not scheduled to make any money. Their earnings are flat for the next couple of years. So that's one of the reasons why Jim Cramer probably said to not buy it. They pay a big dividend, but they're not growing. So let's see. Well, he said remove Pfizer and Kraft Heinz. And he said to buy GE. He said to buy GE Aerospace. So I thought it'd be interesting. He mentioned GE a couple times, as a stock. We know GE split into multiple companies, but do we know what it's actually, what its financials look like after the split? So I thought it'd be interesting to go and do some research on GE. But so to make this more diversified, he removed the duplicate healthcare, and he took the food out because they're not growing as much, and he put in GE. So let's look at GE. Oh, we have one more. Oh, I promised that was the last one, but I have one more. Here's another one. NVIDIA. They're a semiconductor company. BlackRock, they're a financial company, but they do a lot of real estate. They're an investment kind of company. Berkshire Hathaway, we know them. ARM is a semiconductor company, and we have Trane Technologies. They do air conditioning and heating technologies. All right, any idea for this portfolio? All right, we're going to see what Jim Cramer says. Okay, so what Jim Cramer says, we have a duplicate in ARM and NVIDIA. Both of them are semiconductor companies. ARM is actually a company that they allow companies to build their own chips. So they're kind of a little bit different, but they still are involved in semiconductors. So he said remove ARM and replace it with Eli Lilly, one of his favorite healthcare stocks. So you had two semiconductors, financials with BlackRock. You have kind of another financial with Berkshire Hathaway, but he allowed it because Berkshire Hathaway they're all over the place. They're not just financials, they're insurance. And you have a conglomerate of heating and cooling. So now you have a healthcare with a little bit less tech. So that is the last one I'm doing for diversification. The end goal whenever you're diversifying is to try to, this is my portfolio. I'm still pretty heavy on tech. I have 50% of my portfolio in tech, but I'm trying over time, if you put the categories for each of the stocks that I have, I'm trying over time to move this 53% over to these other sectors to be more diversified. So you want to be able to adapt to any environment, high inflation, low inflation, high growth, low growth, a stock market that's crashing. You try to get an even amount for every sector, and then you're more diversified. Chances of you being consistent earning over time is greater. Okay, so we're going to go over GE Aerospace just for kicks. This is a stock that Jim Cramer recommended on his Are You Diversified segment. I went over its earnings estimates, and I was surprised that they basically, most of what they make is jet engines, and they service jet engines. So that's like most of their profits. They're growing at around 20% a year. I was surprised. I wasn't expecting this, but their PE is 20. That's their current PE. So they're actually fairly valued. If they're growing 30%, 20, then